Okay, everybody, I've got a fun situation that I want to work with you on. I thought I'd record this little video because no doubt at some point in your trading career, you'll run into this type of situation. And the situation is as follows. We've got a nice little trade here on NVIDIA. It's a covered call. Bought 100 shares of the stock. Threw on the covered call here for earnings. We got 1 day till expiration, so we need to close this out sooner rather than later. And we've got a $455 gain. But when you look at it, we picked up the stock at a good price, and after earnings, that thing gapped up, and we've got this $2,500 profit on the stock. But because we sold the 110 call, we get capped out at 110. They call us out, and so oh darn it, that covered call is robbing us. This is kind of where the covered call. Yeah, we made money, which is great. We got to feel great about the fact that we made money, but it's a little frustrating because when you look at the risk graph on that here, and let me back that up a couple days so it shows up. It's got the cap gain on there. And again, if you take the stock out of the equation, I mean, what you're sitting at profit-wise on the stock is phenomenal, a $2,500 gain. And we own the stock at 107 and promised to sell it at 110. Got paid $1.65. So that is kind of the challenge, and I've kind of got the game plan out there where we're going to look at rolling the trade, but it's capped the gain. And so, we're going to get called out if we don't buy that to close. And it's always kind of a, do I really want to buy that back and take the $2,100? It's really, not going to really make that big of a difference. But the question I think would be is, do you think that NVIDIA is going to keep rising? So here's the implication, post earnings, boom, it gapped up on crazy heavy volume, establishes this lovely new high, and it pulls down. And we've got this big inside candle here, and I think that looks like a nice little bullish retracement where I think this has got more upside potential. And so that makes me go, well, I could probably roll that option up, take the loss, collect a little bit more premium, and maybe sell like a 135 call out here, or even a 140, and just raise the potential gain on that. And so we're going to analyze that. And the simple way to do this is to simply put in a rolling order. But let me show you. I'll stick build it. So we'll analyze a closing trade. And this is where you take the big loss. Let's go figure out what the bid-ask spread would be on that. Let me actually look at the ticket on that, just see what we can get. We can, looks like we can buy it back for $22.80, so we can save a couple pennies there. So let's analyze that. We'll go right click, analyze closing trade, buy it back, drop that down to $22.80 or so. And what that will do is that'll uncover the stock, and it will realize the loss on the covered call. Now, the next step would be to sell the new covered call. So we'd go add a simulated trade, and I was thinking we'd go out towards June. We own, we're going to get called out here, these May options. If we roll it out to at least June 29, oh, it looks we got filled on the iron condor there. What we'll see here is we can go sell a new call and collect some money, maybe the 135 here, and collect 470 bucks or so. And when we do that, the risk graph looks kind of funny. And the reason that is because the options have different months of expiration. And so, we can go sell that for 470 and change. And that will change our obligation from promising to sell it at 110 to promising to sell it at 135, a higher price. And that's fine if we do that. If it keeps running up, we'll get called out at a higher price, but watch what it does to our bottom line. So without the adjustments, our maximum profit on that is going to be $461. Look at that number right in there in the corner, the blue one. When I point to that, that's the maximum gain, $461. Well, if we roll that up, buy back the short call, and then sell a new short call for the month of June, that will raise the maximum profit, but the graph looks a little funny. And to fix that, to understand the implications, we have to march the calendar down here past expiration date. And so when we do that, there it goes, boom, now you see the new covered call. And we've got a nice break-even point down here above 120. And here's the 135 strike price. And you'll notice that the maximum profit and loss here, again, watch the blue number here when I point to that. went up to $1,151. So we just double up our maximum profit on that just by rolling this trade. So now let me show you this, the easier way to do that. Rather than stick building it and putting those in one at a time, you can simply right click on that and analyze rolling order, or create rolling order, analyze rolling trade here. And it'll pop that open, and then you have to pick the strike price and the expiration date. So here it's got May 26th. So I thought we'd roll that out to at least June. 16s or 23s probably work. So 23 June, and then we roll out up to, and we can go as high as we want on that. And if we go, 135, it will be a debit. It'll be a loss, but it'll set us up where we still have some decent time decay working for us, and that will extend our potential gains out a great deal more. And so we can actually just hit confirm and send on that bad boy, and that splits all the bid-ask spreads for us, makes life easy, and relatively simple trade. So we'll hit that and roll it, and that should take a second to fill. But buying back the call at a loss, it allows us to extend the stock gains, and we still do have that net loss, which is not a big deal though. But just like that, boom, we've now changed the net outcome, and we've released the stock and promised to sell it at a higher strike price, and thereby extending our gains. So we're still winning on the stock. We're just simply promising to sell it at a higher price and accepting the loss on the call, which was made up for with the stock gains. And so we don't feel too bad, but it changes it from, oh, darn it, we won, and we only made $455 to, oh, darn it, we won, and now we're at least doubling that up and making over $1,000 on that, making now the maximum gain here. You can actually see with the final scenario actually taking that out of the equation. Here's the 135. Now, the thing it's not factoring in is that $1,500 some odd loss. So here it shows $3,300, but now the $1,500 for buying that back's out of the equation. So it's still going to be about a $1,500 maximum gain once that comes out of the bottom line. But rolling that up was a pretty smart move. And if you ever find yourself in a situation where you're facing expiration and getting called out, and you've got nice gains on the stock, and you're like, you know what, I don't necessarily need to let them call me out. You can roll the trade or buy back the call still on the stock. And yes, you do take a loss on the call, but you've made up for that with the gains on the stock. And we brought in another $500 in premium. Woohoo! Yeah. There you go. Coach D, tackletrading.com.